Welcome to our third Money Makeover Facebook Live event for this year. For those of you who are new to Money Makeover, this is a challenge we run every year at City Press in partnership with Absa. And we take 6 people through a money boot camp by pairing them with an Absa financial advisor. We're now 4 months into the 2021 challenge. And while our candidates have been working on paying down debt, they also need to look at growing wealth. So today we're focusing on investing, and this is especially around creating a passive investment income. Because let's be honest, isn't that our ultimate financial freedom for all of us, to have our money working for us and paying us an income? So tonight we're going to be looking at both property and share investing. I have 2 Absa experts joining me this evening. I have Miguel Martin from Absa Home Loans and Craig Pfeiffer from Absa Stockbrokers. This is an interactive session, so please post your questions and we will answer them. And we're also going to be posting links to articles that relate to our discussion for you to read for additional information. So please just keep an eye out on the link below. But I'm going to first invite Michiel. I keep saying Michiel. Michiel, welcome to my. I keep saying Michiel. I keep trying to change him into a Spanish man instead of Miguel. Thanks, welcome, Miguel.
It's Mig with an L. Miguel.
Miguel. Obviously spent far too much time with Spanish people. So Miguel's actually he's our resident property guru for Money Makeover. In fact, last year, Miguel, you worked with Colin, one of our candidates, and you really helped him to reshape his property portfolio. So what advice would you give to someone who is looking to start a property portfolio?
Thanks, Maya. So great to be back here and be representing Absa Home Loans and working with investors. As an investor myself, that question is something that I get asked in my personal capacity, as well as through investors at Home Loans. And one of the first things I can say to a new property investor is, first of all, go and invest in yourself. Invest in education. Get to understand this industry that you're getting into. Invest in yourself before you go and put your hard-earned money and savings into a property investment. Property investment seems relatively easy, but like anything else, it has its nuances, and being prepared for that investment will more than pay back. And then the second one is, if you're going to be using home loan to leverage yourself, prepare yourself for finance. Look at your affordability, calculate how much you can lend. Look at your credit score, and if it's not as good as it should be, start putting actions in place to improve the credit score. And then finally, save for those transfer fees, because even if you are able to get a 100% LTV loan, which we all aim for, there are still going to be transfer fees. So save for those, start saving for their transfer fees, and that saving itself builds up a good habit of managing your money and saving towards goals. And the final one, the third and final one, decide up front if this is going to be a hobby investment or if it's going to be a serious investment, because that will really determine your investment strategy, the type of investment property that you get into, and how serious you're going to take it. And there's nothing wrong with having property as a hobby investment, but I think there's a very different approach when you commit yourself to seriously investing in property.
And Miguel, I think we saw that with Colin last year. It sort of started off as a hobby and then became more serious. And suddenly he had a whole lot of these properties and they were a little bit mismatched. He didn't have a proper strategy in place. And I think I think you said to me at the time, you said a lot of property investors fall into it accidentally without a plan, and how important that plan is.
And I see it so often, Maya, where property investors inherit a property or opportunistically purchase a property that becomes available to them at what they think is a great price. And in Colin's example, he had properties over 3 provinces, I think it was. And one of his biggest challenges was managing tenants and vacancies and viewings and maintenance across three different provinces. It was stretching him. It was costing him more in the end, etc. So, I think getting into your first one, maybe two properties, getting into it casually can be okay. But if you really want to build up a serious portfolio, you need to be thinking about things such as location, whether it's sectional title, freehold, whether it's buy-to-let, whether it's flipping, so many things. And that's why, your first question, invest in yourself and build your knowledge. And then and that will really help you to decide what strategy you're going to follow and how you're going to apply yourself.
And also part of that is to decide at what point you put this into a company structure or a trust structure. That was also part of Colin. He collected them all in his personal name. That left him with quite a lot of risk in terms of estate duty and that kind of thing. So I suppose it's all part of educating yourself and making sure that this is part of a plan and not just something you kind of randomly doing. This is a lot of money. I mean, property is a significant investment.
It's a significant investment, and when you decide to go into trusts and PTYs and those structures setting them up takes time and money. So and also, one needs to understand the implications of financing a property in a trust and standing surety. And if that property is not managed well, ultimately, you as the investor, as an individual, is still liable for their property, whether it's in your name or a trust or a PTY. So it's such an interesting space and so much learning that never ends. But you really got to get your feet wet. You got to get involved. You got to start reading the books, attending webinars such as this one, and speaking to other investors who have been in it for some time and just getting direction. But ultimately, it's your investment. You're putting your money down in this particular asset class, and you really have to own the decisions that you make. And really, I encourage people to do so. Property investment is super interesting. It's something that I can speak to friends and other people at a braai. It's really interesting. I enjoy it and would definitely recommend it, but definitely not doing without some good education up front.
Well, Michiel, we're going to bring you back just now, but I'm going to we're going to hear now from Craig, who's going to talk about a very different asset class, which is, of course, shares. So welcome, Craig. So Craig is also a bit of our resident money makeover expert. You actually worked with Zamu, I think 2 years ago or 3 years ago, looking at putting together an investment strategy for him. So, how does someone start a share portfolio or an investment that can provide them with an income in the future? Because, Craig, I think a lot of people don't realize that you can do that with shares and, with stock market related investments. I think property, they don't realize that you can actually create a passive income from shares. So how do you go about it?
Well, I think the first thing to do is if you're fortunate enough to start at a young age, as early as possible. Because this is a game where compounding is also your friend. Over the years, as you can generate an income and reinvest that, you can grow that little acorn into a huge oak over time. I think that's what the stock market and shares is all about, is investing small to start, but growing that wealth, creating wealth over the longer term. And also, as you get more money, as you get more developed in your own life and your salary increases you get those bonuses, and take some of that money and put it into the markets. But at the very outset, you can start, you don't have to have all the expertise at the outset. I think the first and most important thing is to open up some kind of an account with an institution that trades in shares, a stockbroker or a bank. And you can do that at Absa Stockbrokers. You just go online and you can open an account, provide your FICA, fund the account however much you want, and then you could buy your first share. And again, you can also buy one share or two shares. You don't have to buy. When you look at an Anglo-American share at 600 Rand, you don't have to buy 100 of those shares anymore. You could buy one. You could save up to buy one. and just make a start. But I think even at the outset, when you don't have a lot of knowledge about all of these individual companies, you can look at buying an exchange-traded fund or one of those instruments that really gives you exposure to a whole basket, a whole range of different shares, like a resources exchange-traded fund, which will include the Anglos and the Billitons and all of those. So you don't actually have to know very much about resources, but just to have a view that you want to be investing in resources. But you start small. As you get more expertise, you can start dabbling in individual shares. As your investment portfolio grows, you can also then look to diversify. And that's the first thing I would do is to start looking at exchange traded funds and maybe starting a debit order and get something going every month, so it's continually growing. The money goes out of your bank account before you start spending it. Before you know it, that little nest egg, along with some help from the market, it doesn't always go up. And that's why we like the markets, because they do, history has shown us, go up over the longer term. And it can have huge amounts of volatility from day to day. Today is not a great day to advocate for stock markets. It's down, I see 2.6% today. But it's this volatility that scares people away sometimes. But over the longer term, if you stick it out, you will grow your wealth, grow your investment portfolio. And then from an income point of view, you can look to those shares in time that provide you with the biggest dividends. So these companies, they earn money, and you as a shareholder in that company are entitled to some of those profits, and they're distributed via dividends. And you can take that dividend, and I suggest, when you've still got a long investment time horizon, you take those dividends and then you reinvest them into the market. You buy other shares with that. And so you're growing your capital base over time. So, hopefully at some point, near your retirement or at retirement or post-retirement, you've got a large investment portfolio, and you can actually just live off the dividends, just from the dividend income coming from the shares. It's very possible.
And very cost effective, tax effective, because of course dividends are taxed. There's a withholding tax on dividends by the company. So the actual company that issues them, be it Anglo American or Pick and Pay or whatever it is, pays the tax, not you. So it doesn't add to your taxable income. Perhaps that would be an argument later on when we discuss the difference between property and shares.
Yes. That
would be an advantage. I must say, that was a strategy that we've used for my mother's retirement fund. We actually have it in a high dividend yielding. And I remember when the stock market crash happened in 2008, she said to me, "But why am I still getting the same income? Why is my income? All my friends are telling me they've lost money, but I'm still getting my monthly returns." That was because, of course, the company still continued trading. It didn't matter that there'd been a massive stock market crash. Pick and Pay was still, people were still going to Pick and Pay.
Still operating, yes.
They're still operating. Now, of course, COVID was a little bit of a glitch because everybody did actually stop trading for a period of time, but that is an extremely unusual scenario.
Yes, I mean, these companies operate in the real world, so they are subject to the economic environment and different forces. We've talked about Anglos and Billiton and resources. Those are cyclical companies. They go up, as economies ebb and flow. The demand for resources, increases and decreases over time. So, those share prices go up and down. And as I said, over the longer term, as those companies generate more and more profits, it's not a straight line. They do go up and go down. And those are cyclical companies, but you can also have events that, one-off events that might impact a Tiger Brands and a listeriosis breakout, for example. That was quite damaging to them for a long time. When I say long time, a year or two, that kind of time frame. But they see themselves through that, and potentially their earnings do suffer at that time. The dividends might come down. But if you've got a portfolio of a range of investments or companies that you've invested in, they won't all stop paying dividends or reduce their dividends at the same time. So at the moment, we've seen the banks, they were impacted and even requested by the Reserve Bank to hold off paying dividends during the course of last year. But at that time, now the resource resources companies are riding a fantastic commodities boom. They're paying special dividends, and they're making extraordinary profits, and they're paying above normal dividends. They give you your regular dividend, but then they give you even more than that because they're making extraordinary profits. So it swings and roundabouts. The banks have started paying dividends again, so that's great. But they've traditionally been very good dividend payers, and that should be reinstated again fairly soon. So yeah, just keep a diverse portfolio, and when one or two of those companies don't perform, hopefully the others will.
Well, they always say diversification is the only free lunch in terms of investing. Well, Craig, thanks for that intro into investing in shares. I'm going to bring McGill back on, because I'm now going to have a little bit of a debate, I suppose, because this is the debate I always get thrown at people, the property versus the share investor. So McGill, I'm going to ask you to go first. Like, why do you think property is the best investment, the better investment? Why do you invest in property and not shares? Or maybe you do invest in shares, but plug property for me.
So I just heard the referee ding, 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 and let's get the match going, right?
Let's get the match going.
Yeah. So first of all, I'm going to say that I advocate to have a diverse portfolio. But as much as you should have a diverse portfolio, I truly believe, and there's a quote: "What you focus on grows." So I think you should have a couple of things on the go, and definitely I do have an ETF that I contribute to, but and I leave that on the side. But I focus on my property portfolio. And why I choose property? Well, a couple of reasons. First of all, if we think about leverage, if I have 50,000 rand, I can go out and I can pay the transfer fees for a 1 million rand property. And then on that particular asset, two things happen. One, I hope and I expect that 1 million rand property will grow in value over time. And at the same time, I've got a tenant who is in that property, and they're paying for the costs of holding that property and paying that 1 million rand loan down. So I get the benefit of the pay down the loan, as well as the property growth. Secondly, I'm not a very clever guy, so really understand. I find share trading, equity trading quite technical, but I understand property, and for me, it's easier to get into the understanding of the fundamentals of finding a good value property, having a working knowledge of leases and where to go and get good leases for a tenant, and then managing that tenant. And then also where to go and get good advice and content on the issues that do come up. So for me, property and the technical aspects of it seem understandable. And then risks in property is quite forgiving. I find that if there's a downturn in property, the value might reduce in worst case scenario, but the rent continues. And so property, and if I buy a property that where I maybe didn't get my numbers quite right, although the property transaction is quite expensive, you pay transfer fees to get into property, you pay agents commissions to get out of property. Generally, I'd like to think that property is quite forgiving. And then lastly, it's a personal choice. I like walking into properties. I like seeing the bricks and mortar. I like envisaging that people will be living there. I like doing the deal. I like negotiating a price and then managing that tenant. And personally, I like to see my investment portfolio growing as opposed to tickers on a screen. So that's that's a personal preference. But definitely do support a diversified portfolio. But where you focus is where you grow.
I love that. Where you focus, where you grow. Craig, your pitch for getting everybody to buy shares or investing in the market.
All right, coming out of the blue corner, I guess. No, look, I think what Miguel said there was quite important. Two things. One is that you must only invest in what you know about. You must certainly understand what you're investing in. and you must invest in something that's also going to give you some kind of enjoyment or reward in doing that. I like watching the tickers on the screen, and I like knowing that I own a piece of Richmond, and they're producing luxury goods and watches, and they're all over the world, and fantastic jewelry, and I own a piece of that. It's admittedly a very, very, very tiny piece of it, but that's my company. I'm also mining all over the world in Anglo-American. I'm mining iron ore and diamonds. I'm in Western Australia as well with BHP Billiton. We're mining iron ore there too. So it's just the stories and around each of these companies. The stories aren't always positive. Sometimes they come and bite you. Being an MTN shareholder, and then Nigerian government wants to change their regulations, and now you're up for billions of dollars fines. I mean, it's nerve-wracking at times, but it's also exciting. And there's always a story and around every share, and it also ebbs and flows, and you go along with the journey as well. And you have to have the time to invest and and think about all of these things, and think about MTN going to Nigeria, or is Naspers owning so much of Tencent a good thing at the end of the day? It's going to happen to Tencent rarely. So you have to think about all of those things when you're investing in individual shares. But you do have that other alternative of firstly, going with an ETF, an exchange traded fund, or a unit trust, or a fund of funds. So there are different ways of accessing the equity market. So I would think buying individual shares is probably for the more sophisticated, or at least the person who wants to expend the time on doing that and understanding those. And some people like that. Some people are just happy with a unit trust, or even just to give us their money to manage. I don't want to know, I need this invested in the equity market and generate a return for me, and generate some income as well. And they're happy to do that and pay us a fee for doing that. And we sit there all day, every day, and do what we love, and watch the market and watch all the red on a day like today, but then hope there's more green over time than red. And that's quite rewarding when you can actually, you've been with clients for 20, 30 years, and they're getting to retirement, and you're also getting a little gray in the head here. But you've helped them grow their wealth over time. It's quite rewarding. But I'm agreeing with you that it's horses for courses. Not everybody wants to go into individual shares, has the time for it or the inclination. But there are different ways of investing. And I would just say one last thing around the difference between investing and trading. When I look at the market, I like to think of myself as an investor. I've actually hardly ever sold a share, and it's more for me a long-term buy and hold strategy. Sometimes you do have to get out of shares. Even the best companies can go south and have a bad day, a bad year, or just turn bad. And Steinhoff is a perfect example of when things can go bad. But you've got that diverse portfolio, and so that's investing. You're doing it for the longer term. You're trying to grow your wealth. The trading on the other side, on the other hand, is also can be fun, I guess, for those guys who want to get in the market on Friday and get out on Tuesday afternoon, and buy Anglos at 600 today and sell it at 630 next week, and that's also fun. And maybe there's a case that even investors could dabble a little on the side and have a bit of fun with 5% of their portfolio or whatever. But grow your portfolio and stick it up for the longer term. And I hope we can both we have a unanimous draw decision at the end of this.
Yeah, so as the referee, I mean, the comment I would make is I was born and raised in when I say my career started in stockbroking. So I work for a stockbroker. So I'm a share girl. And I'm not crazy about property. And I'll tell you why, because I see Cheryl Sack has just made a comment. And by the way, please continue making your comments and posting your questions here that we can answer. And that is, I don't want to deal with tenants. I really don't want to deal with tenants. It's just, to me, like a mission. And and I'm not. I think I must have commitment issues because property is a lot more difficult to get out of than shares. So for me, I've also preferred shares, but also through the years, what I found, it was just interesting. You spoke about investing versus speculating versus just putting your money in an exchange traded fund. And I mean, technically speaking, I can invest in individual shares. I actually have enough knowledge to do so. But I realized that I didn't have the time to do it. So I had this share portfolio, and I'm generally actually quite good at buying shares. I'm terrible at knowing when to sell them. So I just realized I wasn't paying attention to it. And it reminded me of my vegetable garden. So I have a vegetable garden. My vegetable garden is great fun, but it feeds the birds more than it feeds my family. So it's not there to feed my family. It's there for a bit of fun. And for me, individual shares, sometimes you see an opportunity. It's a little bit of fun. It's a small percentage of my portfolio, but the bulk of them really sit in ETFs, in unit trusts. I just don't have the time. And I think that comes back to, and McGill, as well, property requires time. It's not one of those things that you can just leave. Although Claire's asked, are there any property ETFs? We'll get to that, Claire, because there are. But for me, individual property, buying a property requires time management.
No, absolutely. So I think if you're going to go and look for, so as an investor, whether it's shares, whether it's property, you're making a decision that for the medium to long term, you are going to look for an alternative source of income and wealth creation. That's what sits behind any type of investment. And if you're going to decide to take that and grow that in your own way, whether it's through the support of a group of shares such as unit trusts and ETFs, or whether it's by pooling investors and a power team around you for the property investment, it's about that focus and that decision that you make. Also looking at Cheryl's comment about landlords and tenants and the challenges there. The reality is, some people are telling great stories about property investing. And some people, and then you hear the horror stories. That you often more hear the horror stories than anything else, and I think those are the two extremes. And then there's in the middle, I think, where the reality is, which is it's not colorful, it's not exciting, it's just the everyday. I've got a property, I've got a tenant in there. I have a couple maintenance issues every so often. That tenant turns every 18 to 24 months. I have to advertise. I have to find my plumber. I have to, utilize products and services such as TPN Credit Bureau. I have to, to manage my risks, etc. So, I've got it's a side hustle in many ways. Unless I hand it over to a lettings agent, but then, that's like handing it over to a broker. Your share portfolio, and it's a side hustle, and I think you got to decide whether that's going to be, again, is it going to be a hobby or is it going to be a business? Both are decent strategies, but both bring on very different requirements from you as an investor.
Absolutely. And I just want to go now to that question quickly around property ETFs. Craig, I'll let you answer that one.
Yes, there are, and that gives you exposure to a broad range of properties, and on the equity market as well. Even if you're putting together a portfolio of individual property shares, again, always advocated that you have a diverse portfolio there, that you don't just have one property share, but you have a couple of property shares, because that gives you diversity, across the country, across the globe, even across retail, industrial, office, and you want that diversity. Sometimes office is completely out of favor. There's just too many offices, or retails. We're overmalled. So it's always good to have, I think, diversity in that property space rather than just one single focused investment. But certainly there's things that ETFs that follow, like the SAPY, the SAPY index, for example, and that's a very good way. And property shares are great for producing income. You can buy them just like shares on the JSE, and they provide an above dividend income. There is a different tax regime. You're normally taxed, I would think, at your marginal tax rate on that property income. But they are available on the market, and ETFs if you don't have the expertise.
So I suppose the big difference is obviously, Mikhail, you'll be investing in residential property. I mean, what you're talking about is primarily residential property, and there aren't really any residential, many listed property companies that actually focus on residential. I think some of them have a little bit of residential in their portfolio, but they're not predominantly residential. So they will be more geared towards commercial space as well. So, again, you can actually diversify by having residential property, by buying individual and renting out, but also then having some ETFs in the listed property space. So, so I think what's fantastic is there's so many ways of diversifying your income. I mean, Mikhail, you were saying, you can put down a deposit on a house, on a property, have the tenant paid off. You could start with some exchange traded funds. You can buy some individual shares. You can over time really develop an amazing diversified portfolio which produces income that are not correlated to each other. That they offset. So one's doing well, the other's not, and you really can give yourself quite a nice balanced portfolio. But we have a question here. What's the advantage of buying individual shares versus exchange traded funds? I suppose it's diversification and access, isn't it, Craig?
Well, you could you could buy a top 40 ETF, or you could buy 40 shares yourself. Again, it's just around which you prefer as an investor, and then the top 40, you buy the ETF, you don't have to worry about it. As the index changes, as stock prices go up and down, it's all taken care of, and you're going to get a dividend out of it. There are other investors who like to stand on the first tee and talk about how Anglo's in their portfolio did over the last week, rather than how the exchange traded fund did. No one's going to really tell you that story. But it's just there's a lot more color to buying them individually, and you can change up the weightings yourself. But again, as we said at the outset, you have to have that expertise, and you have to watch it all the time and keep a keen interest in it as well. That's why they call the one sort of more passive and the other active. The passive, you just buy it and leave it, and you don't have to worry about it. The more active approach, you might want to tweak your holdings now and again. But it's horses for courses. You could also get the same kind of exposure from a unit trust or a fund of funds. So it's really different ways of getting to the same animal, and it's just your personal preference and how much time as well as the money you want to invest in it.
So I see here a question. I'm going to throw this one to Mikhail now, which is from Cindy. Hello, Cindy. Cindy's our resident. She always joins these webinars because she's a big property investor. And I think, Cindy, I think that registered business or personal name, Mikhail, I know Cindy's got quite a few properties, and it's one of the things she's debating. How do you make that decision?
Sure, that's really such a personal decision, because it really comes down to where you stand with your portfolio, where you stand in terms of, so there's a tax element to it, there's an estate planning element to it, there's a risk element to it. So the reason why one would want to grow a portfolio in a trust or a PTY and effectively outside their name, and then it will depend on what tax benefits they see to doing that. Estate planning, if you pass away, the properties that are sitting in a trust, they continue. It's really just bringing a new trustee. From a risk perspective, if you're running a business and then you're concerned about the risk in that business, and the creditors might come and attach you and your assets, if those properties are sitting in an entity outside of you, well, they can't attach the properties. So so there are various reasons why an investor would go and look at using a trust or a PTY to grow their portfolio. Generally, if you're growing a portfolio of properties, that would generally be the way to go. But you definitely would want to get some specific advice from your accountant and from a lawyer. My personal experience is that neither of them gave me the answer I was looking for. I had to make my own decision, because they do look at it from very different perspectives. But it's really about getting yourself educated and then ultimately making that decision, because there are financials to be run. There are tax and SARS submissions to be made. There's definitely that administrative side that's that's required when it comes to looking at PTYs and trusts. But really, you can get as creative as you want to in this property game, and really it does open a lot of options and flexibilities. But always look for good advice. Go and so that you can make your own decision.
And Michiel always talks about putting a good team around you. And I think if you're going to get into property seriously, not just like I have a single, like Nkawe, one of our candidates this year, she just got a single property. That's one thing. But when you're starting to really want to build an empire that I think Cindy's planning on, I think you need to put together a good team, even as a good maintenance team. I think you've said, even find a good maintenance team, find people that you can use to help you manage your property. And I think that's excellent advice. I do see here, I think it's a Tisha Oliphant. I just thought it was a very interesting comment. You got into property as a hobby, you've enjoyed it, you're trying to invest in shares, you find it challenging, and it takes time to research the best companies to invest in. So maybe that goes to the earlier question about individual shares versus exchange traded funds. It does take time. And I think if you're buying individual shares or you're buying property, you've got to know that that's what you're doing and make that your focus. So for me, if I was making property my focus and I had tenants and all that, I'd probably stick with my exchange traded funds and not, you've got to focus where the growth is. So, but it's also fun. And I do think around the braai, around the dining room table, around wherever is where a lot of those share conversations tend to go. Somebody's asked about Kruger bits. Now, I have to tell you, I've not heard about Kruger bits, buying gold through Kruger bits. I just know every time I hear something like that, it sounds a little bit scamish. Craig, have you heard of Kruger bits? Buying gold through Kruger bits?
I haven't heard of Kruger bits. Guess there's different ways of investing in gold, and there are ETFs as well, exchange traded funds, just on the gold price. When you invest in those, though, you're hoping in one of two things. One is that the gold price keeps going up, because they generally pay no income, those gold ETFs. So you need the gold price to keep going up, or you need the rand to keep weakening, so that your rand value of an ounce of gold keeps going up. So you need those two things to go in your favor, and you've got to take a view on both of those. The alternative is to buy individual gold mining companies, the advantage of that when the gold price is running is that they have that operating leverage. Their profits fall to the bottom line a lot quicker as the gold price goes up, because they've got an infrastructure base already that's operating, and those costs are fairly standardized. But as the gold price goes up, their margins go up, and they make more money, and you'll make more money out of the gold shares, the gold mining companies, than the gold ETF or a Kruger Rand, for example. When the gold price is going up. And conversely, when the gold price comes down, you're going to lose relatively more out of those gold mining companies. So those are the two approaches I know about, but Kruger bits I'm not too familiar with.
Look, people also buy Kruger Rands. I think one of the concerns with Kruger Rands, of course, is you've got to store them somewhere, and if you have them at your house, they've got to be in a safe. But that's obviously physical gold is another way into gold. That has always been very popular in South Africa. We're a bit of, I think we're probably the only country in the world could tell you the gold price at any one time, any day of the week. But I had a great question. I had a very interesting question through on Twitter, Michiel, which I think I'm going to put to you on property. And he asked, he wants to buy, his mother's going to sell her property to him below market value as a way of, I suppose, giving him an advance on his inheritance or whatever. So he's going to buy the property below market value. What are the tax consequences there? And, what happens, I suppose, one day when he wants to sell it? Is he going to have quite a big capital gains tax implication?
Sure. So that's quite an interesting one. So maybe if he's going to finance it, the bank will finance it at the highest of the purchase price or the market value. So even though he's buying a R1 million property, but he's only paying 800,000, for example, the bank loan will be max of the purchase price at 800,000. Okay, so let's start there, because I often get asked the question, if I get a discount property, can the bank lend me more than what I purchased it? And at the outset, banks only finance at the purchase price. You can come back 6 months to a year later and the revaluation, and then access the additional amount. But you've got to start there. In terms of the tax implications, and I'm definitely not a tax expert, but I do know that when you do that purchase, there's actually a question that gets asked. There's a SARS, a South African Revenue Services form that your registering attorney hands to you, and it's there just to see if it's a linked transaction. Are you associated with the seller? And if it is, and you are, then they will check the market value on that. They could check the market value on their purchase, and the difference could actually be considered, I think, a donations tax by the seller. That's my limited understanding of that transaction, but you got to watch out for that. And then when it comes to the buyer, in a few years later, possibly selling the property and then selling it at market value at the time, they may have to deal with capital gains tax, because now they'll be making a larger profit because they got the property at a lower price. So and then there's capital gains tax that comes in consideration, etc. So in that kind of scenario, definitely would talk to an accountant, to a tax accountant, and just get their thoughts on the current transaction and then the future transactions and the implications of that. With these kind of things, the intent is noble. It's the parent wanting to help the child out, but there are unintended consequences that can come of that can impact both parties.
Good advice. I've had a question here about investment option between an ETF and an index fund. So I suspect, Victoria, what you mean here is an exchange-traded fund versus a unit trust index tracking fund. That's pretty much the difference. Really, is one is a share, because the exchange-traded fund is actually a share on the JSE that you buy through a stockbroker. And an index fund you buy through an asset manager. Craig, anything else you'd like to add there?
No, I think that's it. You're essentially just buying a basket of shares or exposure to a range of different companies through a single investment. So whether it's a unit trust that follows an index or an ETF, it's really just the same thing at the end of the day. You're still getting that same underlying exposure. And the first thing I'd probably do is go and have a look at the cost structure and see where you're going to pay the least to get that same exposure. That would probably be, for me, the biggest differentiator.
I'm going to actually just ask, I've got my community manager, Marlene, watching this. I'm going to ask her to quickly check on my website, because I'm sure I've got something on exchange. I think it's called How to Select Your Exchange Traded Fund, and it'll probably give you some insight there, Victoria. So we'll see if a link pops up. Next question, how do I identify the safe and reliable online investment broker if I want to start an investment portfolio, but I'm intimidated as I'm totally illiterate regarding trading? Outstanding question. There are endless con artists out there. Endless. So Craig, I'll let you weigh in on that one. How do you know that who you're dealing with is legitimate?
Well, I think it's just like choosing a lawyer or a dentist or one of the things is you probably want to have a good referral for someone who's had a good experience and has some history with that particular service provider. I guess that's one way. Another way is just to stick with those big names that that have been around forever. I like to think Absa is one of those, but certainly there are other big brand names out there that one could consider. If it's Mr. Fly by Night or something you've never heard of, maybe it requires a little more investigation. But there's plenty of long-standing members of the JSE that that have a good history. They've been around for a very long time, and if you have any doubts, stick with those names. Or
well, that is a comment.
We've had some references on.
Yes, I mean, or they must be licensed by the FSCA. They're a member of the JSC. You know, because they actually are then monitored and overseen by those, and there's a fiduciary responsibility. They're regulated. So I think where I see a lot of those online scams is generally they're offshore. So they are based in the Philippines, or they're based in Malta, or they're based somewhere else. And the problem there with referrals is that the referrals are often fake because they're all online. So
Yes.
I would just stick with, and also there's some excellent, South African companies that you can invest in offshore. I mean, you can go to Absa and you can buy shares offshore. You can go and buy offshore shares with all of the stockbrokers that are South African based. And for me, I just like the idea that there is a physical presence in South Africa that I can go and I can find, because when it's online and it's sitting in the Bermuda or something, what are you going to do? I always say to you, what are you going to do? You can't get all of them. Where are you going to get your money back? Is an ETF generally cheaper regards fees than a unit trust? I suppose that's really the difference. I mean, a tracker unit trust, an index unit trust, is actually quite similar to an exchange traded fund, I think can be. But it's an asset manager making an active decision. So Craig, maybe explain what an active fund manager does for a unit trust.
Yeah, well, an active manager in a unit trust is buying and selling shares, not all day, every day, but they're continually in the market, and buying and selling and tweaking, and new flows come in and some go out. So they're trading that portfolio, looking for good alternatives here, there, and everywhere to invest in, and you just invest in that via the unit trust, which is the word collective investment scheme is quite descriptive, because you've got all these collective investors into one investment vehicle, and you've all got a little piece or units in a unit trust. On an ETF, your manager is just simply following exactly what the index does. They want to give you the return from the index, no more, no less. And they also want to earn a little fee out of that as well. And their fees are generally quite very reasonable, to get exposure to the market in that way. So those managers typically would look at doing in the background some script lending and some other kinds of things to generate an extra bit of income to reduce your fee, help the income as well, but to keep fees as low as possible, while at the same time giving you the return of the index. If the index goes up 10% today, you want your ETF to go up 10% as well, and to have that identical matching. So that's what the ETF manager does. He tracks that index. If the weightings in the index change, he's got to change them exactly in that same proportion to give you that same return. But a unit trust manager, just a general equity unit trust manager, he's looking at opportunities all over the market.
And I think, Craig, probably quite an important point with unit trusts is that they can have a diversified portfolio. So they can be multi-assets. So you could have a unit trust that has South African shares in it, offshore shares in it, property, bonds, cash, a balanced portfolio, for example, where that actually gets managed for you. But that can also be done as an index. So you get an index unit trust that's a balanced unit trust. So it has all of those exposures as well, but without taking individual share decisions. So you need to look at it and see what works for you. I mean, one of the things I do think where unit trusts add a lot of value is in the diversification of the asset class. You're not, the ETF, you're only in one asset class. That's it. You're in property or you're in shares, and those shares are only going to be in one index. So you would have to buy multiple exchange traded funds to have a diversified portfolio. And just on that,
yes, you need to diversify.
Yeah, on offshore, I mean, I'm surprised we haven't had questions, because whenever the markets crash and there's political ramblings, we get questions about investing offshore. So, I mean, how should a South African approach diversification offshore?
Well, I think the first thing is that it is an important part of your portfolio. And although, equities is an asset class on its own, you could differentiate it between local equities and offshore equities. And as you mentioned, a lot of the local brokers, such as ourselves, offer an opportunity to buy individual offshore shares as well, your Amazons, your Microsoft, Facebook, whatever it is that tickles your fancy. And it gives you even more exposure and more opportunity. On the local market, we've got Richemont. It's our only luxury brands group in the whole country. I mean, it is a secondary listing, but it's the only luxury goods company we've got. If you go offshore, you open up a whole world there. You can get a Prada or LMVH, or LVMH. All of these Kering, they're all available to local investors. So diversification is additional diversification, and then in individual companies, but then also across the currency as a hedge against rand depreciation. My view, I think our house view, the way we manage our stock portfolios for our clients is with a view that the rand will depreciate over the longer term. So we look to include offshore shares as much as possible. And I think individual investors, if you're doing it for yourself, you should also look to do that. But one needs that extra little bit of diversification in your portfolio from currency point of view. Offshore, you can get access to euro listed shares, US, dollar listed shares, pound listed shares. It's just more diversity and maybe just de-risking your portfolio a little.
And just an exchange traded fund. You can invest in an exchange traded fund that's offshore as well. That tracks the S&P 500 or the MSCI, which is the world index. You can have 1,800 global companies by buying a single ETF. So I mean, I tell you, the day. I mean, Craig, compared to when I entered the market 20 odd years ago, I mean, we're spoiled for choice. But I did just remember, Craig, I had a great link to an article you wrote. Well, I wrote interviewing you, I think the two of us wrote, on how to choose a share. So I'm going to get that up because I think somebody was asking about, whether to buy individual shares or whatever. And I think that would be a really nice link to pop up. So for those of you who are wanting to buy individual shares, you're listening, you're thinking, oh, I wouldn't mind some Richemont because, and by the way, rather buy the luxury brand than the actual luxury item. Much better return on value. So I think that'll be a nice post for you guys who are interested in buying individual shares. But I'm going to take one last question. And that is, what does Michiel think of property stokvels, and is there one he can suggest? Good question.
Sure. Such a topical theme at the moment. So stokvels are a great way for people to come together who don't have a lot of cash to put into property, but together, 10, 15, 20 people, and possibly saving a monthly sum over time can quickly accumulate, that 50,000 rand I spoke to that can get access to that R1 million property. Well, I think that's a theory. The challenge with that is that when you have 20 people, in whose name do you buy that property? And can you buy that property in the name of the 20 people? Well, you can theoretically. It's going to be very, very cumbersome, and banks are, home loan banks are going to look at that, very, very carefully, because the problem there is that if one person passes away, if one person gets sequestrated, if one person decides that they don't want to pay their share that month, they're all jointly and severally liable for that loan. So very, very complex. Possibly they can purchase the property through a company, and each of them will hold a share. But again, really need to get the right advice on how to set that up. So honestly, my personal thought on stokvels is, put the money together until you can buy property cash, because then you immediately get the benefit of the property. Takes longer to pull the cash together, but it's a lot simpler when doing the transaction. But it's something that we often do get stokvels approaching us and looking at how we can help them financing, and it does become quite complex. In terms of suggesting a stokvel, I don't have a stokvel that I can suggest. What I can say is that when you're looking at getting to a stokvel, look at that the members agreement, look at the constitution, how it's put together, look at how robust the governance is of that stokvel, because it's very easy to come together and sell the upside of what that stokvel wants to achieve. But once you've got a treasurer who's keeping all the money, and it's very easy to start give for that person to get alternative thoughts, and also just good sound management of those funds. So stokvel is a great way for people who know each other, have a common thread to come together, but be very careful when those sums start getting to a significant amount, and maybe start looking at alternative ways of getting into property. Maybe it is through ETFs, through a property fund, whilst you build your knowledge, and then possibly realizing that portfolio to actually go into property yourself. So it's how do you grow it? And I think a comment on this is that either whether it's shares or whether it's property, it's not about the deal you do. It's not about where you are today or where you're going to be in the next 3 months. It's about the consistency that you apply yourself, whether it's buying the ETFs or whether it's understanding property and putting the savings together to eventually get the financing for a property. But it's that consistency that pays off over a period of time, and just like a snowball that slowly grows as it tumbles down a hill. Initially, you don't see that growth, but after some time, through the compounding benefit of whether it's compounding interest or value on the share side, or the compounding value of your savings and ultimately your property portfolio, you will see those benefits. Consistency is key.
And I see Cindy, I know Cindy's involved in a property stokvel, and she was saying just make sure the attorneys are involved. And I think that's very important, that you have a proper lawyer, proper contracts. Please don't go to these guys who are all over social media saying, we've got this brilliant property stokvel. It must be people you know. You must do it with people you know. Have a good attorney, and it's not something you just join randomly. And I do know that there is a bank, I actually can't remember which bank it is. If not Absa, I think maybe who's actually now, I haven't actually had a look at the press release yet, that allows up to 12 people to buy a property. So, I think that is coming up now. I think we're going to see more and more of that. And I have no doubt Absa will probably be coming to market with something as well. I think the banks are recognizing this as a space. But I think we're going to have to end off there. I did get a question about whether to invest your entire salaries and then use the interest to pay your expenses. Good luck if you can earn enough interest off your salary to pay all your expenses. You're doing really, really well. But I think that could be a very long-term approach where you build up your investments to eventually be able to pay your assets. Yeah, so Claire, it is F&B. So we're now advertising F&B on an Absa discussion. But here you are, Absa can follow suit very quickly. So I want to thank both of you for coming on and sharing your knowledge, and thanks for all of you who joined this evening. And the recording will go up, so if you joined a bit later and you want to hear what we said, and also put the links in the articles. And please keep following the Money Makeover Challenge. We keep showing, we're going to be showcasing all different aspects of money and management. So thank you to all of you.
Thank you,
Maya.
Have a good evening. Cheers.
Bye-bye.
Bye.